So, what have we discussed so far? That, of course, corporate bonds pay more than government bonds because there is a higher probability that a corporation might not be able to pay you back compared to the government, relatively speaking. So, therefore, they should pay you a higher return. But before we talk about corporate bonds, let's talk about government bonds first. That what do the government bonds pay you and why do they pay you that much? Now, this is some very basic discussion that we've had in quantitative methods. But just to repeat, let's say you can go for a dinner with your family and that dinner will cost you $100 now, or if you go, let's say next year, it will cost you $105. Let's say there is 5% inflation. So now, if instead of going for the dinner now, this year, you say that I will save this and I will lend this to the government, and we will go for the dinner next year. So this $100 that you're lending to the government should definitely become more than 105, right? Because otherwise it makes no sense for you to not go for the dinner now, because then you're not going to be even go next year either, right? Because if the government is paying you a rate which is less than inflation, then there is no incentive for you to save and lend to the government, because your value of your money is going down more than what the government is offering you. So at the very least, the government needs to offer you the 5% return plus actually something on top of that. Let's say that is 2%, right? And it gives you back 107, which is 7% on top of that original $100, of which 5% is for inflation. And this 2% is the real interest rate, right? The real rate that you're actually earning. Because after 1 year, when you go back to the restaurant and that dinner is costing you 105, so after paying for that dinner, what you're really left with is that $2 extra, right? So you could have the dinner now, or you could wait a year and then have dinner. And then the compensation for delaying your consumption is that real interest rate, right? So again, think about it this way, that number one, if you're lending to a government, and let's take the example of the US government, no default risk, virtually no default risk, because they have taxes that they collect from the US economy, and the US economy is very strong, and they can also print US dollars. So there is virtually no default risk. You will get your money back for sure. Therefore, all you need is them to give you a return which takes care of the inflation and also gives you something on top for which you are willing to compromise your consumption today and wait and get something extra in return. Now, if this is the US government, right? Now, if a corporation wants to take my money, so they need to compensate me more than the government rate, right? And this is something we've discussed before, that if you have yield over here on the y-axis and maturity on the x-axis, and if this is a government bond, right, and whatever is the yield that the government bond is offering me, the corporate bond should offer something more than that. And that is where this G spread comes into the picture. And that spread is for what? What is that additional return for? Well, it's for the additional risk that investors take with these corporate bonds, because of course corporations cannot print money, right? So therefore, there is a relatively higher probability that they might not be able to pay us back, and therefore that spread is there. Now, why is this so important? Why is this so important? Because, my friends, bond prices, as you know, are inversely related to the yield to maturity on a bond. And what is the yield to maturity? So let's say this bond is paying 9%, right? This bond is paying 9%, whereas the government bond is paying 7. And this extra 2% is the spread. So now this YTM of the corporate bond is 9, let's say, and this 9 can change, but it can change because of two things. Either the government bond rates are going up or down, which we call the benchmark yield, right? Or it could be because the spread changes. So what you need to understand are the factors that affect the yield spread. Before I get into the factors for yield spread, I hope you understand what are the factors that impact the benchmark yield. And this material is linked to the discussion that we had in economics, or if you haven't covered economics yet, you should look into economics and business cycles. Because the benchmark yield, which is the government bond interest rate that the government is offering, is linked to monetary policy, and monetary policy is linked to where the Federal Reserve thinks we are in terms of the business cycle. So this is all discussion from economics, and the benchmark yield, the factors that impact the benchmark yield are macroeconomic factors, right? This is related to macroeconomic factors. Whereas your credit spread, right, your spread is also related to economic factors, and we are going to discuss all those factors right now. But you as an investor need to understand that your bond price is going to be inversely related to the yield to maturity of that bond, and that yield consists of two things. One is the benchmark yield and the other is the spread, and the benchmark yield is sensitive to a different type of factors and the spread is sensitive to different factors. And we as investors or as portfolio managers or financial analysts or financial advisors, we need to understand these underlying factors so that we are prepared, our portfolios are positioned to take advantage of increases in bond prices and be protected against fall in reduction in bond prices. So what are these factors? And before I get into the factors, again, I want to re-emphasize that you can't depend on the credit rating agencies to help you with the spread on corporate bonds, because the market is fast, right? The market is not going to wait for the credit rating agency to change the rating on a particular corporation and then start selling their bonds, right? If it's a downgrade. Or if it's an upgrade, the market is not going to wait for a credit rating agency to upgrade a particular bond before they start buying. The market participants will be monitoring these factors, and so should you, and act in advance, right? So the credit ratings, they're always lagging. That they have a slow process. They are slow to update, but you need to move fast. And the only way you can do that is if you keep your eyes on these factors that cause the spreads to widen, right? And of course, you need to keep your eye on the benchmark yield as well, and that is linked to macroeconomic factors. So you might have already been listening to CNBC or Bloomberg and all these discussions that they're always having, and majority of the time what they're talking about is interest rate and expected movement by the Federal Reserve. Will they increase interest rate? Will they decrease it? So what will happen to the benchmark yield? What is the yield curve looking like? So that is all macroeconomic factors. So yes, definitely you should have a view on your benchmark yield, but you should also have a view on your spread, because those two combined give you the yield to maturity, and your bond price is linked to the yield to maturity. Now let us get into each of these factors that affect the spread. Right, starting with credit cycle. Now, what is credit cycle? And then we'll talk about all of them, right, one by one. So, what is credit cycle? It's linked again to the monetary policy. So, there is definitely an overlap between monetary policy affecting your underlying benchmark yield and monetary policy also affecting the spread. So, monetary policy definitely affects both. And let's say your monetary policy is saying that we are going to increase interest rates. So they are increasing interest rates, which means your benchmark yield will be increasing, most likely, at least the short end, because the government has more control over the short than the long. So they will increase the benchmark yield if they are increasing the interest rate. Now, what will happen to the spread? The spread is going to become wide, right? The spread is going to become wide. And let's say when the credit cycle is going up, that means interest rates are going down and money supply is going up. But when the credit cycle goes down, right? When the credit cycle starts going down, then money supply starts going down and interest rates start going up, right? So this is when it is going down. When it is going up, interest rates are going down and money supply is going up. So think about it, what's happening when it's going down. When it's going down, corporations are being bothered by the banks to give back the loans, to pay back the loans. Interest rates are going up. So it's a difficult time for the corporations, which means the spread will increase, right? However, if your credit cycle is going up or you're at the peak, that means money supply is high, interest rate is low. It's easy for the corporations to get investment, right? And at cheap rates as well, because interest rate is low and money supply is high. So the risk will be low and therefore credit spread will be narrower as your money supply is easy, right? It's a easy monetary policy, expansionary monetary policy. So as the credit cycle improves and as it reaches a top, your spreads are the smallest or the narrowest, but then they start to widen as you start your downturn in your credit cycle. So as it deteriorates, what happens is money supply starts going down, interest rate starts going up, and you see a increase in your spreads. By the way, before I move on, something very interesting I would like to tell you about, that practically what happens. Right? So practically what happens is that even though when you are increasing interest rate, when let's say you're in a contractionary monetary policy and interest rates are going up, money supply is going down, so the government is pushing the short end up because the government has control over the short end. The long end, the market is more in control of the long end, because the market can then, what they can do is, there's going to be something called a flight to safety, and they buy government bonds. So because of this recessionary environment or this difficult corporate environment, what happens is something called flight to safety, where they buy government bonds. Market participants, they buy government bonds, which means demand for government bonds goes up. So price of government bonds goes up, and it puts a downward pressure on the yield that they are offering, because if the price of the bond is going up, naturally the percentage return that you will make on that higher price will be low, so your yield goes down, and then your benchmark curve kind of becomes flat, right? It becomes flat because the short end is going up, the long end is coming down, but your corporate yield doesn't change. Corporate yield doesn't change because the spread widens. Before, the benchmark was like this, but now the benchmark has become flat, but the spread goes up because, when the credit cycle deteriorates, the spread widens. So actually, what happens is that the yield on the corporate bond doesn't change, because on one hand, the spread is going up, but on the other hand, the benchmark yield is coming down because of the flight to safety and the prices of the government bonds going up. So since the yield on the corporate bond doesn't change, therefore the price also doesn't change that much, and it's actually a pretty good investment to have in difficult times. So this is a very interesting thing, that you can actually invest in high yield corporate bonds, and that's not really a bad investment, right? Even in times where the credit cycle is deteriorating. So yeah, it's just that was something I wanted to share with you. Anyway, so coming back to the second factor that affects your spread, obviously better economic conditions means the spread will narrow, and weak economic condition means that the spread will widen, because in weak economic condition there is higher risk of default, higher risk of default, and therefore your spreads will widen. Funding availability in the financial sector. This is related to your brokers. Well, not really brokers, but brokers. I'm writing broker dealer because we usually use that word together, broker slash dealer. But brokers don't really use their own money. It's the dealers. So what's the difference between a broker and a dealer? A broker is just going to try and connect a buyer and a seller at the same time, right? But it's not always necessary that the buyer and the seller are coming to do the transaction at the same time. So a dealer uses their own money, right? So they would buy from the seller and then wait for the buyer to come and then sell to the buyer, and then obviously they keep a spread for that. Now, depending on how much money funding available to the dealers, right? So how much liquidity do the dealers of bonds have? Because bonds is not like your stock exchange. It's not like an electronic exchange where buyers and sellers are coming and dealing with each other. This is an over-the-counter market, right? And what happens is you have dealers that use their own money to make the market for this, right? And they would buy from the seller and then wait for the buyer to come. So to be able to do that, they need money. The question is, how much money do they have? So the more money they have, so if they have sufficient capital, then obviously the spreads will be narrow. But if they don't have that much capital, well, then the spreads will widen. As simple as that. General market supply and demand, even if everything is good, but then you have this huge supply of bonds coming in, right? Companies, corporations just want capital, and they are fighting for the investors' funds. So naturally, to be able to attract the investors, they will have to offer better rates. So that can happen if the supply is too much of the bonds and the demand is good, but it's still less than the supply. And needless to say, the financial performance of the issuer, right? Because of course, the core thing that we are talking about here is default risk, credit risk. And if the company is good, their earning is good, news is overall good, other developments are positive, then you will have narrow spreads, right? Good news will narrow the spreads, while bad news is going to ask for a higher return, which means your spreads will widen. Now, again, I just talked about this, and I think this point is very good, that investing in high yield bonds is maybe not that bad a thing, right? Even though the risk is there. But as I just showed you, that in times of recession, if your benchmark yield is becoming flat, right? So that is going down. The interest rate on the government bonds is going down. But if the interest rate on the corporate is not changing, right, or the yield on the corporate is not changing, so the price is more stable than we think. Point number one. Point number two, obviously it offers a diversification, right? High yield bonds, which are triple B, below triple B, right? So double B and lower than that is not exactly having the same behavior as your investment grade. So it's a good diversification for you. I mean, it's not as volatile as equity, but it's not as safe as investment grade. So, right, so it's a bit of both. So you get that more risk, but then not as much risk as equity. I obviously personally like equity, but then again, everybody has a different risk return appetite and a different capability of managing that risk. So for people who want a little bit more risk but not so much risk, like equity, then high yield bonds are actually a pretty good option for them. And they can be very profitable, because if you buy them at very low prices when the economic problems are there, and once the recovery comes, the gains can be huge, right? So yeah, very interesting asset class for those who like it. So anyways, I think we've already discussed this, but let's talk about it again, that the price of a bond is related to its changes in its YTM. And this is an option free bond, by the way. If you remember for a bond with embedded options, right, we look at the changes in interest rate or the curve or the benchmark yield. But we're not talking about that right now. We're talking about an option-free bond. And an option-free bond, what we have been doing in the past learning modules, that we calculated their modified duration, which assumes a straight line, and then we calculated the convexity adjustment, which is always positive, right, because it falls lower and rises faster. So to come up with the price change, if interest rate is coming down and price is going up, the convexity adjustment is positive. And again, coming up with the price change, if interest rate is going up and price is coming down, again convexity adjustment is still positive, because the price will fall lower than what duration will tell us. But that's not what's important right now. What's important right now is that the YTM is a combination of two things, right? It is your spread added on top of your benchmark. So if your benchmark, let's say government is 7% and the corporate is paying another 2% extra because of the additional risk, so that's what your yield is. And of course, this 7% also can be broken up into the inflation and the real. But the point is that all of this could change. And you as an investor or an advisor or a portfolio manager need to keep your eye on the YTM, because that is going to impact your bond price. So you need to keep an impact on inflation, you need to keep an impact on the real rates, you need to keep an impact on the spread, and what are all the factors that can impact the spread or the inflation or the real rate, because any of these things can influence the prices of your financial assets. So this is something that we've discussed before. It's a bit of a revision here, that how do you calculate the price change of a bond based on what is the difference in your yield. But here we're not taking the change in entire yield. We are just focusing on the spread part, right? We are not looking at the benchmark. So let's say we set aside the benchmark. Well, let's say it's not changing. It is stable. It is constant. Think of it like a constant, right? Let's say the interest rate is not changing or the benchmark is not changing, and we're just focusing on the spread right now. So what we want to see over here is that what is the price impact from just changes in the spread. And it's exactly the same like we do it for the changes in YTM. The only difference is instead of taking change in YTM, we're just taking the change in spread. And that's without the convexity adjustment. And this one is with the convexity adjustment, where you have your half into convexity into change in spread squared. Now, just one thing I want to tell you is that, let's say if you're given in the question duration of 5 and convexity of 0.235, well, you can't plug in 0.235 over here. You can't plug in 0.235 over here. You need to multiply it by 100. The reason for that is the change in curve or the change in YTM or the change in spread in this case is not squared for the duration, but it is squared for the convexity. Now when you square this, what this becomes is 2 zeros get added to this, right? And therefore it will completely spoil your entire formula if you don't multiply convexity by 2 zeros. So what you really need to practice doing is that duration you can take whatever it is, right? The 5 goes there. Obviously it's negative because you know that duration is always a negative adjustment. Interest rate going up, price comes down. Interest rate going down, price goes up. So we know that, right? And it's even written on this previous slide. Let me just show you. Obviously, like, I mean, it's so obvious by now that I don't think I need to tell you this anymore. But convexity is always a positive adjustment. So this is stuff you should just know by now, right? Duration is always negative because it's an inverse relationship, and convexity is always positive because it goes up more and it falls less. So that is why convexity is always a positive adjustment, duration is always a negative adjustment. But what I want you to focus on right now is that look what they are writing for convexity. They are not writing 0.235, they are writing 23.5. And just to make sure that we have been able to drive this concept home, you have to solve this question. So please pause the video and calculate what will be the change in price if your spread is changing. So pause the video, try to work it out. Don't worry about making a mistake. Even if you make a mistake, it's okay, because failure is a step towards learning, and that is what leads to success. So just make the mistakes now instead of making them in the exam. Okay, so hopefully you've paused the video by now and solved the question. So I'm going to show you the solution now. The duration goes here, the convexity goes here, and obviously we've multiplied it by 100, and the change in the spread goes here. I've just done it for C, and you see the answer right here. The similar thing can be done for A and B as well. So hopefully you were able to get it right. If not, practice makes perfect. So there are a lot of other questions in the curriculum, in the CFA Institute ecosystem website, and of course with our question bank. So please try to solve as much as you can. Here is the summary for this entire learning module. What have we talked about? That credit risk is related to you not getting the money from the borrower. So you as the lender don't get your either principal back or parts of the interest back, or both, right? So principal or interest not coming back because the borrower fails to make the scheduled payments. Now that can be quantified. How? By taking, number one, the expected exposure multiplied with 1 minus the recovery ratio, because obviously there is a collateral in many bonds. So you need to take that collateral quality into account and then see, okay, if I'm able to recover 80% of the money, well, then I'm only going to lose 20% of it, because 1 minus 80% is 20%. And then that, if I've given 100 million exposure, or that is my expected exposure, right? So I could lose 20% of that. And then what is the probability that the default happens? So all of this comes together to quantify this risk. And even if you take out this dollar amount, right, and you look at it in terms of just percentages, right? So let's say this 20% multiplied with a probability of default of 10, then what I will get is a 2% expected loss in terms of percentage, whatever the underlying value might be. Then I can compare it to the spread and then see, okay, is the spread more? If it is, well, I don't mind investing in that, because the risk is less than the reward. And who helps us in analyzing and quantifying and rating this credit risk? Well, it is your credit rating agency. So they are definitely doing a good job. It's just that they tend to lag the market, and they have some other issues like, credit ratings are not fixed, they're dynamic, so they can change. So obviously we cannot just take a decision based on a credit rating and then just relax forever. Number one. Number two, they make mistakes, so they are not foolproof. And think of your subprime crisis, financial crisis, right? Really bad credit rating was done. Those securities probably deserved a much lower rating than they got. And of course, credit rating agencies are not able to pick up on very, very specific risks, such as the Japanese tsunami. And most importantly of all, they are slow to update. So we need to understand what are the factors that they are considering, so we can directly consider them and be fast to move in the market. Now, before I move to the summary of the factors, I just want to talk about Moody's versus Standard & Poor and Fitch, because Standard & Poor and Fitch have a different way of giving ratings. So you have AAA in both of these, right? But Moody's is a bit moody. So they actually have a different way of writing all this. So just wanted to re-emphasize on that. All right. Now with the factors, right? So we've talked about it. Let's talk about it a bit more. you've got your credit cycle. Naturally, if it's improving at the top, your spreads will be the narrowest. As it starts coming down, your spreads will start to widen. Again, good economy means narrow spreads, bad economy means wide spreads. Funding availability, and this is from the perspective of your dealers, right? High funding means thin spreads, narrow spreads, and vice versa. High supply of bonds means spreads will be wide. And of course, most importantly, the earnings and the news and other good developments related to the company itself, because better the company, the lower the spread. It's very, very straightforward. So, hope you enjoyed this very interesting learning module, and I hope to see you in the next one.